So, what do the Venezuela event, Greenland, the 50 plus countries of delegates that were just in the White House this past week, and I don't know, let's throw China into the mix just for fun. What do they all have in common? Better yet, what is it about all of these recent events that should be telling investors to be very thoughtful about where safety is in today's market? Because it might not be where you're used to finding it. That's not a fear inducing statement on purpose. It's more a suggestion to be aware because as volatility continues to ramp up, finding safe havens in today's market may not be where you first think to look. I'm Casey Fulp, CFP, the owner and principal of Carriage Planning. And today I want to share with you some thoughts about the overall state of the markets. This is a video that I recorded for our clients and a deep breakdown of what's going on in the markets and why the episodes recently seen in silver, Bitcoin, international markets, Greenland, Venezuela. Why does all of this actually play together to help us understand, in all likelihood, the direction that our markets are going in? And most importantly, how to set our expectations for success and set our portfolio in a way that will provide us the greatest amount of opportunity while also being considerate of the inherent risks that are becoming more and more evident in the market. Enjoy. Okay. If you've stuck around with me at this point, thank you for staying. I think that this is going to be worth your time. This is critical right now. We are going through a very, very significant shift. It's a shift that it's very rare that we have opportunities in our investment markets and our capital markets where it's not to say that the shift is certain. It's not to say that the signals that we're getting are crystal clear, but the weight of the evidence is packing up in such a dramatic way. And that's very unusual that we're getting so many aligning factors all at the same time. It's almost so clear that it makes me really question, all right, maybe we shouldn't buy in. But the reality is that this isn't unheard of. This does happen. And it happens as a function of the natural state of what has happened prior to. And that's why we can look in history and we can find a lot of circumstances where this has occurred in the past. And I say a lot. I mean, it's not something we see every year. It's something we see every 15, 18, 20 years, let's say, to that effect. But one of the first places to start is to talk about just the general state of affairs as it relates to the United States and the rest of the world. The United States has been front and center for, well, forever. I mean, in our lifetimes, forever. Let's make that a very clear distinction. But over the course of the past, yeah, you could probably say, since the early, well, no, you could go all the way back to like the 20 aughts, like 2010, basically post GFC, post Great Financial Crisis. Right, we saw the world. And prior to that, of course, the world had their eyes on the US because of the so called war on terror and that event. Um, but the financial eyes were reaffixed on the US because the great financial crisis showed a lot of weakness in the armor, let's say. It brought to mind some questions for a lot of other countries, but it also heightened scrutiny on the financial systems as a whole. And while it seems like it was a very long time ago, when you think, back, let's say 15 years, 18 years. The truth is that in the grand scheme of things, it's a flick of a switch. It's a snap. When we saw the collapse of the banking system, the lack of accountability, we saw the hallmarks of what you would find to be a tremendous amount of di- discomfort because of having to question something that otherwise prior had seemed so infallible. And it's not the actual questioning of the thing. That's not actually the problem. The problem is prior to that, there didn't seem to be any reason you needed to really question. And post GFC, questions were very necessary. And to take that a step further, we then saw central banks around the world make very divergent choices. We saw Europe take the approach of what would be deemed austerity. And that austerity led to some very interesting effects. You might recall going into 2012, 13, 14, we saw the Greek and Irish debt crisis, where Greece was the one that pretty much had the headlines. And this is going to come back around in full circle in a moment. So, I'm bringing this up for poignant reasons here, but the Greek debt crisis was supposedly going to end the EU. And at the same time, the US was already starting the process of having the ongoing wars around raising our debt ceiling. And that's because, in contrast to the EU taking this measure of austerity, where it was, we're going to spend less, we're going to do less, right? We're going to be austere, kind of. But yeah, that was the path that they chose. The US took the opposite, and took the opposite to such a high degree, such an extreme degree, that it shifted the tilt of the globe. And I know that sounds wild to say it that way, but that's what happened. But it also set the course for so much of what has been happening, but it also presented other major powers with an opportunity that you probably couldn't have estimated how powerful that opportunity was. Let me explain. When the US took their approach post GFC, they said, we're going to go from a scarce reserve policy, meaning we don't really print money ad hoc or free willy or whatever. We recognize that we need to control rate policy to some degree. We need to control variable factors associated with the way the banking system and the banking system health. At the end of the day, the Federal Reserve was supposedly set up basically to protect banks. It's a banking cartel. And that's an important thing because it's always presented by the proponents of the Federal Reserve that it's to stabilize markets for the American economy and for the average American and for the. No, 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 no. Do not be mistaken. No. I could easily pull up a chart that shows you what Federal Reserve policy is and what the average wealth of the average American is and where the wealth gap differential spread has occurred. And it is solely at the behest, if and not to be hyperbolic, let's say 80% of the responsibility is in the hands of the Federal Reserve. They have made rich much, much richer. They have made poor not richer at all, if not poorer. And they've effectively eliminated the middle class in traditional definitions of the term. But by going to the abundant reserve policy, this all of a sudden opened the floodgates for the debt problem that we now face as a nation. The debt problem was already there. But famously, everyone tends to remember, if you're not old enough to have been alive then, you recall the stories of how, because it's trotted out for political reasons today, but remember, Clinton's the one that balanced the budget. Clinton's the one that balanced the budget. Well, yes, but you don't just balance a budget like that. There were a lot of factors that led into that. And that's not to take away from the Clinton administration's fact that they did balance the budget, but it is to highlight the fact that once upon a time, the Democrats and the Republicans were actually vying for like who could do this. And Reagan's policies were trying. Stockton was a big part of that, and there were some other valid players. And while Reagan was a very flawed character as a president, the administration set forth a lot of policies that were disastrous for a lot of people. But if you had to shine a light on a positive thing, is it set the framework, the course for then George H.W. administration and then Clinton to get closer and closer and then eventually get to that point where it was a balanced budget. But that was basically evaporated with the quote unquote war on terror that came as a result of post Clinton, George Bush. Yes, we have 9/11, and you know the timeline. I want to be careful not to really talk on things that aren't relevant to this picture. But the spending started because of war, but that's always been there. But we were now living, Reagan and Carter, basically post Nixon, Ford, yes, we were living in a world where now all of a sudden there's this great temptation, this illicit fruit was hanging from a tree. And Nixon used it to great effect for his own gain, wrongly. But then that was made worse by Lyndon Johnson. And then, of course, you know, kind of moving forward, we had a lot that happened in the 70s, and we know hyperinflation, and we know, but all of that is a result of taking the dollar off of the gold standard and creating that illicit fruit, that illicit sweet, sweet thing that no politician seems to be able to resist, and ultimately, which is the ability to effectively create money out of thin air for their own gain, for their own means, for their own objectives. Fortunately, we didn't abuse that early, or at least we weren't tempted to. But that abuse really did begin as a result of wars, but that's always been the case. The problem, though, is as wars wound down, or even though they tried to kick those cans down the road and keep them going as long as they possibly could, GFC was the critical turning point because wars all of a sudden started to take a lower rank on the geopolitical scale. Globalization, trade was starting to get front and center. Recall that China was brought into the WTC in the early 2000s. I believe it was 2002. I could be wrong on that year. Could be mixing that up in my head, but I think I'm right on that. But China was sort of living in its own world over there. Then the great financial crisis happens, and then the abundant reserve shift occurs. And now all of a sudden, the Federal Reserve, in combination with the US Treasury and good old Ben Bernanke, while Janet Yellen, crept around in the dark, damp corners of the Federal Reserve abyss, helping to structure what she then exacerbated. Um, but they made this policy where it's all right. We'll just print it. We'll just print the money. 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 And that continued and continued and continued while our debt continued and continued and continued to go up. And then our deficits start getting wider and wider and wider. And we know the story. But all the while, bring China back into the picture. China was now on the world stage, and the US economy was who they wanted to cater to because the US economy had the buying populace, wholly speaking, for them to build their industrial base on. So when they were brought into the WTC, you saw copper run like crazy because they were building out this massive industrial base on top of what they had already begun doing. And then, of course, you have this abundant reserve policy where, even though we didn't have any inflation through the post 2008, 2009, inflation ran very, very low. And a lot of people say, well, how could that be if they're just printing money ad hoc? That's where it gets a little bit tricky because, yes, they were printing money, but it was monetized. It was turned into federal debt. Yeah. That debt was being sold, though. And so long as that equation was kept intact and the rate of growth of the monetary supply was slow enough that the economic growth could be strong, and of course we did have a lot of economic growth coming out of that, they kind of kept in parity with one another. but it doesn't mean the machine wasn't still running behind the scenes. And as we moved forward in time, China is over there more than happy to say, wow, I'm so glad you guys have so much of that money. And in fact, if you're going to buy things from us in that money, and because we have to do trade around the world primarily in the dollar, we need to make sure that we are keeping that dollar structurally sound. So we're going to buy a lot of your treasuries. So we're going to basically be the ones that lend you money when you want to borrow it to make more of your money. Kind of a weird system, isn't it? And that was going fine. And that was continuing. But behind the scenes, the part that wasn't necessarily understood was that was a quid pro quo. And then when Trump's first term comes in, and there was a lot that happened. 2015 was a pivotal year. 2015, you saw this yuan devaluation event, and that can't be glossed over because it was critical. Because China kind of said, like, we're getting pretty big here. Like, let's take a stab at doing something that we need, that we want to do, that's beneficial for us, but it might tick you off. But let's like a kid, right? Let's see how far we can push mom and dad before they really snap. And boy, did they! They pushed our markets hard because they devalued the yuan, which in turn changed the structure of the dollar as it relates to the fact that now China had a much greater presence in the world. And when they devalued their yuan, it made other currencies around the world stronger. Okay, by relative, you know, context. But China wasn't buying from the rest of the world; they were selling to the world. So it made their stuff cheaper to the rest of the world. The U.S. got hammered by this because it was like, oh boy, that big machine, that big thing over there, that big blob that we call the CCP slash communist China slash communist light China, whatever you want to call it. All of a sudden, they it's like the 18-year-old, right, that like challenges the dad to a game and you know puts dad in for a run for his money. The rest of the world kind of went, what's that, right? And from that point, fast forward into again about you know 3 years later. I mean, think about it. 2015, 2016. 2016 is the election for Trump. I mean, this was all happening. Pop, 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 pop. And then Trump goes to a proverbial war with China over. I mean, remember, like his first term, most of that was like, we need to treat China. We're not treating them with kid gloves anymore. Like these are adults. They are not this emerging market economy anymore. Like we need to treat them the way that we treat other trading partners, and we're going to go hard on them and da 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 da. And everybody got really worried because it's like that's going to then he's stoking fears with North Korea. I mean, like it's crazy to think, but that wasn't that long ago, and most of it's like whoop, all out of our memory. Uh, but that's what was going on there. And supposedly all these China deals were happening. And one of the critical provisions in one of those major deals was that China had to agree to not manipulate their currency anymore. And that agreement never really came to fruition. And then, of course, Trump leaves office and we get Biden in, and Biden, or proxies for Biden, had vested interests in changing the course back to the way it was, which was letting China get away with whatever they wanted to get away with. And that's not saying either one of those is right. But the reality is behind the scenes, the US is still more than happy to keep printing their money, printing their money, printing their money. 2020, right at that critical juncture where Trump and Biden switch positions, we get that election year, right? 2020, COVID starts at the start of that year. And what does the Federal Reserve do? But at the behest of the Treasury and Congress, print, 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 print. Pump money into the pockets of every American. We're going to save the economy, but we're also going to tell you can't go to work and actually do anything for it. Meanwhile, other economies around the world had very strict restrictions, right? China being namely the one. And they're still pumping stuff out. We couldn't necessarily get it into ports, but let's say the economic product and service base didn't necessarily deteriorate at the same pace as our economic capacities did. And our money supply goes up, products stay or reduce a little bit, which in that case they actually did reduce, right, just by virtue of things slowing down. But more money chasing less goods creates inflation. Wonderful. Okay. Low rates, inflation. What do? We go in and we try to both stimulate the economy and slow it down at the same time. So while the Federal Reserve was happy to buy assets onto their book, meaning they were buying them from the market, putting them on their ledger, they were also printing money effectively. But then they reached the point where they say, we need to stop the printing money and we're going to buy less, maybe even sell a little bit back to the market, and then we're going to raise rates, and that's going to cool the market down. And they raise rates. But here's the problem. By this point, the US debt issue was large. It's been large. Why it gets even more impactful, though, is the debt issue gets really bad, but now we have to pay a higher amount of interest on that debt, which we're already running a deficit, meaning we're already spending more than we are taking in. All right. And then the rate of interest, our credit card interest, went up. Okay. But the real key to this is then China was like, I don't think I trust you as buyers. I don't think I trust you as a place to lend money to. In other words, my safe place where I'm going to park my money. I know you're going to pay me back. Not anymore. I don't know that you're going to pay me back anymore. I'm going to go ahead and start selling my treasuries. So they're pulling money back into China. What are they doing with it? Well, if the idea of buying a treasury is for safety of your money, in other words, the safest place to park your money, and that place isn't so safe anymore, where do you go? You go to another country? Well, you tell me, what other country is viably competitive with the U.S. in terms of its economic feasibility, future, forward-looking? The U.S. is pretty much the top dog. Okay, where now? Hmm. Let's go back in history. Where is the one place that people have sought store of value more than any other place? Gold. Because of its very unique properties, gold has been one of those few assets, metals, that because it's such a stable and difficult thing to manipulate and to change and to modify, and it stays gold no matter how many times you melt it, and it doesn't bond well with other metals. It's kind of an alien species, really, in truth. So they start buying gold like crazy. That's pushed our gold prices up. Let's take a look at gold. Let's put it into context. I'm going to jump over here to a gold chart, and I'm going to use paper gold, which when I say paper gold or paper silver or paper anything, I'm saying this is the cost of the paper contracts. The bullion is going to price very differently because it's real metal. But we use the paper prices because that is what the market is showing us in terms of the perceived price of the asset. It's not perfect, but let's just take a look here. Going back to 2019, here's a run up into 2020. This softening here was as we were figuring out COVID policies, globally speaking. Here's March 22. This is where the rate hikes begin in the US. You see gold going down because the rate hike temporarily stimulated interest in US treasuries. You could get more money on your treasury, right? But then once those rate hikes pretty well stopped, which is down here at the end of 22, no more rate hiking. Now what? Who's doing this? Who's taking gold that was pricing down here at 1780 all the way up to nearly 5,000 right now? Primarily central banks around the world. China was the leader. Was. Not anymore. China was the leader. Why are they doing that? Well, it's twofold. It's not just because they want a safe place to put their money. It's also because they are now looking at their money as being the thing that they wanted when they were selling their treasuries. Well, I can't put my I can't find safety in a treasury right now. I don't trust the US. I don't trust the US economy. Maybe it's not that I don't trust them. Maybe I'm finally reaching that point where now I'm very competitive with them. What if instead I make our currency the strongest? One great way to do that is to back it with something. That's what the US has done up until FDR plus Nixon. FDR started the process of taking us off the gold standard. Nixon put the nail in the coffin. Okay. China has been amassing gold, but that's not just what they're amassing. They are amassing real economy things. China is notable from its emergence from, let's say, infancy into adulthood. And they are an adult now. That economy is very much an adult. It's an adult that has a very different parenting style, or not parenting style, but like, they were parented very different than the US, right? They're communist, and they are communist. I'm not putting air quotes on it, like they're not, but they play a different brand of communism than the traditional, let's say, Marxist developed iteration that became Eastern Bloc communism, right? Um, but as China has done this, they are now looking to say, what if we could supplant the dollar as the global reserve currency? This has been talked about, but has been pretty easily waved off for the better part of the last 3, 4, 5, maybe even 7, 8, 10 years. It can't be put off anymore, and here's why. One, the proof is in the pudding. They're doing the things to get there. They have a very explicit agenda to do this. Now, will it succeed? I don't know. But to reiterate the fact that they've been doing this explicitly, it's important to note that in 2024, Xi Jinping, supreme leader of China, into perpetuity, mind you. That's an important thing that changed just a few years back, but he will be president as long as he wants to be. They had the Belt and Road Initiative back in the early aughts. That's still probably happening. It's just not getting a lot of press coverage. But in 2024, he made a private meeting presentation laying out his step-by-step policy and plan for making the yuan, the renminbi, the global reserve currency. That stayed behind closed doors. It just so happens this past weekend, right after that single day major hemorrhage in precious metals, which, if I were to bring the chart back up here, we're talking about this day right here. This is Friday, January 30th. We had this largest single one-day pricing event downward in gold and in silver and in platinum. Doesn't really matter. You pick your metal. Pricing the day start at about 5,400, ending the day down here at 4,908. He released that video of that private presentation the following day. That is called striking while the iron is hot. He recognized, or the CCP recognized, or they may have been a big player in that particular event happening. This is our time to go ahead and let the world know it's not just a secret anymore. We very much are doing this, and this is our plan. And we're so far along in our plan, you're going to have a much harder time stopping us. Okay. I mentioned, though, they're not just buying gold. And I also mentioned China's not the biggest gold buyer anymore. Who is? Well, as of the past year, this might be a surprise to you. And this is going to tangentially come back together for the full story. And I will tie it all into the portfolio and the investment space, because it matters, because I'm not just saying we're investing in gold or not investing in gold or whatever else it is. This is going to help build framework for you and a map for not only what you should expect, but why we're taking the steps that we're currently taking with the portfolio. Again, so long as the evidence, so long as the technical details comply with what it currently is suggesting. Past year, number one buyer of gold as a central bank, Poland. If you're like anyone else, you probably are thinking to yourself, Poland. Yes, Poland. And by a handsome amount. Poland has actually announced that they are effectively seeking to raise their, let's call it sovereign positioning, the country's money, central bank money, upwards of 30% in gold. Now, just a quick flashback to American history. Fort Knox, now my neighbor, right, just down the road. It's been a very hotly contested concept, Fort Knox. Just the abstract idea of Fort Knox. It's been James Bond movie. It's been uh, it was very controversial in the 70s, but every president, or at least many of them, senators, reps, when they're petitioning for office, they will say, we need to audit Fort Knox. We need to make sure the gold's there. Nobody's ever seen it. What's the deal? Where is it? Is the gold there? We don't know. On paper, it's there. Is the gold there? We don't know. We truly don't know. There's some evidence that would say yes. There's some evidence that'll say no. But when did all that gold get there? That's an important piece of this puzzle that we have to understand. It wasn't always there. When the US was building its own currency, historically speaking, prior to the Civil War, post Civil War, and I won't get into all the history about it because it's fun, but I can dork out on that way too much. But silver was actually more significant as an underpinning for the various currency iterations, and that's why a lot of our early coins, even into the 21st century, excuse me, the 20th century, um, had dominant silver content in them. 90% silver, junk silver coins were 90% silver, 10% copper, I believe. The numismatists in the group would understand, but gold became a big deal really as a function of post World War One, pre World War Two, and then into World War Two. A lot of people kind of ponder, well, why all of a sudden? Well, it wasn't all of a sudden, but because of the major regime shifts that were occurring as a result of World War Two, and of course World War One with New Deal and the insane policies that came out of that, um, there was a lot of changing of hands of metals, but there was also a lot of uncertainty around the globe. So people were doing what we see people today do in economies that definitely don't trust their governments, that don't have any reason to trust their governments, like India, like China, like a lot of the emerging economies. The people want to hold gold and silver and precious stones because they don't trust their own currency, even if it is backed by something, because they don't trust their own governments. So the US was in a very similar situation. And as we came out of World War One, when a lot of Americans, and I mean this is left out of the history books because it doesn't help further the objective agenda. There was a very large percentage of Americans that had no interest in being in World War One and hated the fact that the US got involved. And they didn't trust their own government. Rightfully so. So they were hoarding gold. Reasons we'll leave out of the conversation. This doesn't matter for financials. But what does matter is FDR was basic issued his famous gold grab decree, and American citizens weren't allowed to hold gold. It became illegal. You had to turn it in. You had to trade it in for money. For money. You were being a good citizen. You were being a patriot. Turn in your gold. That's where the gold hoard in Fort Knox basically was birthed from. That's where it was born out of. There were other factors at play, there were other sourcing, but that was such a critical point. So as we go overseas and we look at the case of Poland, China, the gold, the silver, the metals question can't be ignored as gold bugs like it has been for the longest time now. Because now gold isn't just this safe thing. I can't put my cash in a coffee can. When central banks are buying it up, and specifically Poland isn't a very clear case here. And I'll explain why in a moment, but it's important to reiterate the fact that gold had to be it represents something that is now very much in demand, not just by people, not just by citizens, but by governments. So position the government as though they are the people and they're looking at the world and they know that the US has basically been the government, like the government of governments. And they're now looking at it going, I don't trust that. Poland notably went on record, not on record, but they officially bucked the trend in Europe back in 2019, 2018, 2019 is when it started. But if you're not familiar with the concept of the great replacement theory, it is this idea that and leave your opinion out of it and being white guy here, right? There's plenty of people who will tell you, shut up. You're just whining and whatever. And no, I'm a data guy. I've always been a data guy. And the reality is that the percentage of white population globally is a fraction of what it once was, whether it was rightfully white or, and it doesn't matter about the skin color. What matters about is these nations in Europe and the US to some degree, but have had a concerted effort. Why? Whether it was altruistic, humanitarian, I don't care. Whether it was, we're involved in these bad things around the world in these other lands, these other countries, so we feel bad about. So we're gonna, we're gonna grant refuge to others. I'm not looking for the answer. I'm simply saying the reality is that most countries in the EU specifically have been importing people from other countries at a very high degree. Where that gets interesting is Poland said no. We are all about Poland. We are about the Polish people, the Polish culture. We are not playing that game, and we're going to protect our people. And I think that that is an interesting thing to do while you are also buying up a lot of gold. Because that tells me Poland, while yes, is very friendly to the Western ideologies, or at least what we traditionally would view as Western ideology, they're in a very unique position in the world. They're very globally central to the two hemispherical powers that are both contending for dominance in the globe. And you would say China, but there's Russia adjacent, right? It kind of maybe pro China, maybe not. We don't know. There's a lot of questions there. Then there's, but kind of think hemispherically. Poland kind of finds itself Europe, Russia, and what would be Eastern tending uh, uh, governments slash countries slash whatever. They're stuck in the middle. And they're basically saying, we want to make sure that we are well positioned to do business with whoever we need to be Polish, to protect the Poles. It's a very telling story because they're not the only ones doing it. But when you look at a chart that shows how much gold they're buying, they're trying to future proof Poland. And that doesn't mean hitch our wagon to the US. That means be independent and stand alone and be willing to say no when others force us to try to say yes, but we still won't. And better yet, position us so that if we need to break free and go join a different team for our own benefit, we're going to do it. More countries are going to start doing that, and they already are doing it, but Poland just stands out because of how much gold they're buying, as we can see in the chart. Okay. Let's bring this whole story together and put a bow on it. I mentioned silver several times. Silver's been a hot button item lately. I mentioned the manipulation of markets. I mentioned paper markets. An important consideration to keep in mind is that paper markets mean contracts on physical metals. There's inherent premiums and discounts placed into that market because of the fact that the metals have to be somewhere. It's not like I have a metal bar in my hand, I'm handing it to you, and in turn, you're handing me some other exchange of value, be it cash, or it's a barter trade, or it's a whatever. Okay. When you're trading paper, it's way easier. That's why we don't trade gold bars for food at the grocery store, right? We don't want anything that has intrinsic value to be used as transactable currencies. We like to have our store of value, and then we like to have some representation of that store of value because it makes life easier. That's the birth of currencies in our modern context. But when it comes to investing in these things, yeah, you go buy a bar, go to a store, go to a dealer, and you can buy a bar or a coin or whatever. But if you're looking to be nimble, where you don't have to go to a place, bring the physical thing with you, give it to them, hope that the valuation, right? You own a paper representation of the security, or the in this case the metal, the physical thing. The price of the bullion and the price of the paper over the past 3 weeks, 2 weeks really, completely divorced. Got to the point where there was a spread differential of about $40 on silver for the bullion price on street markets, specifically in Asia, and the paper price, and this is, looking at currency conversions, but there was about a $40 spread on something that was only trading at about $120. So you're talking about a third to a half of the actual value of the thing differential between the real metal price and the paper representing the metal. That's a problem. Part of the reason was the people that owned the paper contracts, they were saying, give me the metal now. I don't want the next contract. I don't want to buy another piece of paper representing it. When this thing comes due, this piece of paper, this futures contract, or this option, or whatever it was, give me the metal. I want it. Why? Well, for silver's sake, it's an industrial metal. For gold's sake, central banks are buying the stuff, and we only have so much of it on this planet. That's a known quantity. It is a fact. There is no more gold, no alchemy. We're not making more of it. And we also know it's a fixed, finite amount, and it's really hard to get to. Okay. Silver, much more readily available. It's a byproduct metal for the most part. It's a byproduct of processing other metals, other abundant metals, but it does require significant manipulation, but it doesn't make it more expensive. It's not harder to get or anything like that. It's just, it just requires work. China can do the work. They have the smelting facilities. They have the production capacities. Most of the mined metals in South America, Latin America, go because that is where most of the silver and copper, and even though there's plenty of ore deposits around the globe, that's a concentration point. They get shipped over to China, they get rendered, and then they get shipped back. It's kind of comical, really, because China has the capacity. Because China historically, culturally, and India is the same way, and a lot of the Eastern countries are, they put a tremendous amount of value on physical metals. It's a very traditional perspective, but we in the West, we're so advanced. Of course, we have Bitcoin. That's not to say Bitcoin's bad. I'm not making fun of Bitcoin. What I'm saying is that is the psychology of the American mind, or the Western mind. Is those are archaic. We don't need metals. Ugh. Yeah, we do. That goes back to that human philosophy, right? We disconnect from nature. We're going to come back. It's just a matter of time. But with that being said, those paper contracts, that price divorce, that extreme price divorce, was probably manipulated by the banks. And I say probably, I have no actual proof, but I can say with a high degree of certainty that the price of the actual metal didn't go away. It's the price of the contracts that went down. And the reason being is all those banks were on the hook to deliver that metal. And if they couldn't, they have to basically say uncle. And then all of a sudden, the trust and the faith in that institution just vanishes. And that institution goes out of business, whether it be a big commercial bank or whatever else it might be. So there were players that were using very, very strong thumbs to push the scale, to move it back into a position, which is why we saw silver go all the way back down from 120 or whatever it was to 70. And let's see, what did we end up doing? We peaked out somewhere around one intraday. Okay, intraday, to be fair, 121, and intraday, as of even today, we traded all the way down to 64. Right. That divorce is telling us a very, very important story because silver is an industrial metal that is an absolute requirement for the non natural tech based world that we have now created for ourselves. Semiconductivity. Silver is the most conductive metal. We don't have anything better, especially in a non alloy. There might be some alloys that are being developed, but they're still probably going to require some silver. Beyond that, the gold side of the coin, all of this, these things have significant demand. They have significant demand coming from big, big, big buyers, central banks, stable coins, right? The Bitcoin cousin that's supposed to be this digital currency because it has a store of value backing it. What is that? The same thing we've always gone to, gold. Tether has bought tremendous amounts of gold. Tether's this most dominant stable coin because they're backing their currency in effect. But the other part of the equation with the silver thing is that in all likelihood, there was an order issued very discreetly behind the scenes, and I have this on good accord, that the US government reached out to its main players. I won't name names, but they are private sector, publicly traded companies that have significant storage of metals. And they said, you've got these metals. We've been quietly been bringing these metals back over from overseas in the London vaults and in vaults around the globe. And we've also been quietly accumulating these, which is why these companies, you know what, let me just say it, banks, have had significant fat short positions on these metals because they're being asked, told, encouraged, forced to begin hoarding them. They don't want to get caught holding something that can go down, so they buy a short contract on it so they can lock and they can stabilize their own balance sheet and their own books. But they were probably told you cannot actually do not let that metal leave our country. And that's what drove the silver price way up. Because when those contracts were coming due, the banks went, oh, crud. What do I do with this? I can't give them the silver that I have. Fine, fine, fine. Okay, you have a contract. You want delivery. You actually want the metal. We'll go find it somewhere. So we'll go out into a public market. We'll go out into another market in another country and say, give us here, give us the silver, give us the silver. We got to go give it to this guy for this contract. We'll pay you for it. And then of course they're losing their margin on their product, their paper product. But that was all happening, driving the prices up. And then, of course, once it got too high, they're like, we're losing, we're going to go bankrupt. This is gonna kill us. So what we need to do is we need to go in and we actually need to shove the market back down on the paper, which is likely what they did. Meanwhile, the bullion price continues to be fairly stable, although it's retracted back in. The new story that you're hearing about is this great China investor that has shorted silver to the tune of, I want to say it was an absurd number. It's like 300 billion or something. 3 billion, 300 billion. Either way, it's an astronomical figure. But he shorted almost more than what's viable for exchange, right? So the metal that's actually in an exchanged marketplace that could actually go somewhere, he's betting against it more than what's even there. But then you come to find out that that particular investor and his company are de facto extensions of the Communist Party. So you say, why would they be wanting to devalue this so much? Maybe they do, maybe they don't. Maybe that's a really good story to get out into the public, that they're shorting it. And maybe that's giving them an opportunity to continue acquiring. Maybe they wanted to suppress, maybe they wanted to remarry paper price and physical price so that the market's more stable. Because right now, when there's a huge differential, guess what people aren't doing? They're not selling their silver. And if I'm a country who's trying to acquire silver, I want that price, even if it's higher, I want the paper price to meet the metal price. Because if it doesn't, the buyers are going, I'm not getting rid of my metal. My metal's like, that's holding tremendous value. The paper is worthless. I'm not giving it up for paper. Okay. They need velocity in the market. They need the metal to change hands. So There's a chance that that's what's going on there. But the end story is that the industrial demand has not changed. Solar still requires silver glue, silver adhesive. It's like a spackle, basically. Um, Data centers, it's the most efficient, and they're already energy hogs. They need efficient conductivity. That is silver. Gold, on the other hand, what's up with gold? Well, gold keeps cooking because central banks keep acquiring it because the dollar is losing its value to the world, not its value in price, its perceived value as a tool. And China is positioning themselves to try to unseat that. So now let's put the crown jewel on the cake. Why this matters for the portfolio. Why are we more international? Why do we have a high commodities, even though commodities are volatile? Look at the silver price, right? Let me flash that back on the screen. Why would we own these things? Okay, here's why. Just this past week, with very little fanfare leading into this, in fact, the announcements, you would assume invitations had to be sent out a couple weeks ahead of time, but the US hosted delegates from 50 nations on Monday, Tuesday, Wednesday, I believe. Did you hear about this? Probably not. The 2026 Critical Minerals Ministerial. Ministers, foreign ministers from 50 different nations met in DC with Vice President, Secretary of State, Treasury Secretary, Interior Secretary, Energy Secretary, ambassadors. I'm sorry, 54 countries. I said 50, 54. And the European Commission. Talking about the importance of critical materials and critical material supply chains. Politicians use political speak, and it's going to sound like we need to reinforce our strong relationships with our partner nations and blah, 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 blah. Let me translate for you. We need to make sure that we have our critical materials because we recognize that we are in a pickle. And we are up against a very, very strong foe who is wanting to unseat us. And this isn't fear stoking about China. Let me make that clear personally. Let me say that. I'm not fear stoking about China. I'm telling you, this is how they are viewing this situation. The trap was set by America. They knew where it was. They choose to walk into it while ignoring the fact that they're now trapped. And after they've done all of this, and this was all a known quantity, now they're going, oh, crud. The Greenland deal plays heavily into this. The Venezuela deal, oil, plays heavily into this. I'll show you oil in just a minute. But what also plays heavily into this? The Export-Import Bank of the United States. Something that most people have never really heard of. However, they play a big role, especially in a tariff-based world. Oh, remember those tariffs? Remember how the Supreme Court's supposed to be deciding on those tariffs? Whether they're constitutional or not? Whether they would have to be refunded or not? What an interesting coincidence that they haven't announced their ruling, even though that verdict was supposed to be announced. Just saying. There might be some reasoning behind that. Exim approves Project Vault loan. What is Project Vault? Oh, Project Vault is Trump's $12 billion critical material strategic allocation fund that was just created a few days ago. At least it was announced. $12 billion have been allocated to acquire not only critical resources to hold in strategic reserve, but also to align strategic partnerships for future acquisition of these critical materials. That's a big deal, and virtually no attention is being paid to it. Why is it such a big deal? Because the critical materials are the things that ensure the safety of the United States in the event bad things happen. Are bad things going to happen? I don't know. Is the US all of a sudden deciding they need to really, really aggressively position better for those bad things? Yeah, they are. Part of the story with Venezuela was kicking the Chinese out. That was part of that story. The oil part, big part of that story. The wildcatter up in the uh, natural gas dominant oil sands regions in the Dakotas that pulled his entire interest out because the margins are too tight. He's not making money. Natural gas as a whole has kind of all of a sudden fallen to the wayside. Why? Well, just so happens that petroleum is actually the thing that the US needs more than anything, especially if they're going to run their military and if they're going to protect themselves. And better yet, that dollar that's really worth nothing more than the promise of the US government, because we have gold, supposedly, but no one's ever seen it, and we have a whole lot of debt. Now all of a sudden the US is going, boy, it'd be really nice if we had some other stuff that we could back that up with. Better yet, let's also stabilize our own industry. We're reshoring. Remember the reshoring story? Okay. We're friendshoring. Remember the friendshoring story? We're hemispherically aligning ourselves to be positioned in the event hot war breaks out, but also in the event that we need to stabilize our own currency's veracity in a global marketplace. Because if we start losing global trade partners, when they start backing off of the US dollar, when they say, no, I'll go trade with China direct, that becomes a big problem for the US because that's been the US's greatest negotiation strategy to basically keep foes friendly. They control their money. And no better example than what happened with Russia and why this has been escalated so much over the course of the past 6 years. Because when Biden came in and the entire nonsense blew up with Ukraine and Russia, whether Russia was the aggressor or whether it was the fact that the US and NATO were all of a sudden going, hey, we're about to put basically a 50 cal machine gun at your back door. And you don't expect them, when you said you would not expand NATO, yet you continue to expand NATO. Obviously, you know that I'm going to take responsibility. Like I'm looking at it as the US needs to take a little bit more responsibility, whether Russia was wrong or not. You can hold both as evil partners in your mind. It's okay to have a little cognitive dissonance with that. But the reality is that the US wasn't a non instigator. But what makes it so important to investors is that the US overtly weaponized the dollar. They made the dollar now a weapon against a foreign foe. They said, we freeze your assets because you invaded Ukraine. Now all of a sudden, we froze your assets. So all these other nations around the world that are like, look, we like the US, they're great. But man, if we upset them, they could just like freeze our trade because we trade in the dollar. They can just freeze it, or they could even take it. Oh boy. So you get cases like Poland. Bring some gold in over here. Let's use that money. Let's go ahead and buy some gold. Uh, let's backstop ourselves here just in case, because maybe the right thing for Poland isn't the right thing that America wants Poland to do. Well, boy, it would really stink if they froze the dollar on them. That put them in a real bind. But that's the way a lot of countries are looking at this. Trump creating the strategic materials is basically saying we can't use the dollar going forward as a weapon. It's not going to have the same effect and the same force. We're not going to be able to force other countries into doing business with us, even when they don't want to. So instead, we need to make the dollar more appealing. We need to back the dollar again. So part of it is unfortunately going into other countries, taking their leader, whether he should have been or not taken. It doesn't look that. That's the thing is stop thinking there's a side in this and start looking at it to the best of your ability as, is this principally right or wrong? Because once you do, you go, if it's principally wrong, why did they do it? Maybe there was other reasons for it. And whether that justifies it or not, I'm not saying that. I'm saying it has to be considered because then we start to look at our own portfolios and we say, okay, imagine, for example, The Federal Reserve chair, new chair, Kevin Warsh comes in and says, "I'm going to be a policy hawk. I'm going to sell assets off our books. All right, meaning I'm going to suppress the market. I'm going to pump assets into the market when the market may not necessarily have an appetite for them. And then I'm also going to raise rates." That's his story. That's the hawkish Fed that caused the market selling, coincidentally, on the same day that the silver market went down, because what that does is it drives the dollar up. And that can easily be illustrated when we look at a chart of the dollar. That same day, here we are, Tuesday, Wednesday, Thursday, Friday. Look at that one single day big move, almost like it's opposite of what we saw in silver and gold. What a coinky dink. Okay, the story there is this will be a strong dollar policy. This guy's going to do it. Or, like I said at the very beginning of this, perhaps the Fed is just a mouthpiece to sway markets with sentiment. Mission accomplished. Now, whether he gets approved and the Senate votes him in has yet to be seen. But assume he does. Now, all of a sudden, he's enacted this policy, selling off the federal asset, the Federal Reserve's assets off their balance sheet and raising rates. Now, all of a sudden, the U.S. debt became even more expensive than it already is. We're already spending annually more servicing our debt, mainly, in other words, paying the interest on our debt, than we are on our own Defense Department, our Department of War, military. We're spending a lot of money on that. You raise rates up, that means every new note that we issue as a nation costs more. And then we roll those notes over. That's how we fund our debt. And that now makes it even more unaffordable. And then the argument would be, well, then, okay, we're suppressing inflation. Are you, though? Because at the end of the day, all of that's happening, rates are up, economic productivity slows down, you're depressing the economy, and you're setting the stage for what will become stagflation. So is he going to do that? No. I can say with a very high degree of confidence, no. He's going to say he's going to do that. And that's achieving what they want to achieve, because when I zoom out on the dollar, forgive all the fancy lines and everything, that's a big fat breakdown. The accelerated decline in the dollar was faster than they wanted. They needed to get it back, coincidentally. Look at this line, this long red line. Look at that. You see this big fat red line here? Okay, that is a trend going back all the way to 2011. And that trend has been adhered to in the dollar all the way through 2020, 2021, COVID, and forward. And now all of a sudden we have this aggressive breakdown. We touch it, we go back up. We break down, we touch it, we go back up. We break down way through it. That went too fast. The metals manipulation on the markets, the fact that we did the Venezuela thing, the fact that we are going for Greenland, the fact that the debt spending and the budget approvals continue when Trump petitioned not to do those things, the fact that wars continue. The world is looking at the dollar saying, nah, you're not holding up your end of the deal. You're supposed to be safe, and this isn't safe. The rest of the world also looks at, okay, what is their most economically viable thing, the US? Well, it's AI, of course. It's computer, it's tech, it's intellectual property. That has cooked, right? We know that has run hot. You're not the only investor who's going, should this come back? Like, should this, like, maybe just like a little bit? Like, I don't think it should just go forever, right? Right. But when? Could be now. We've been pretty flat on the Mag 7 for some time now. I can show you. Look at that. From August 25, give or take. pretty much flat on the Mag 7. They're not doing anything. Okay. We're watching what is called classic rotation in the markets. For the portfolio, this is the takeaway. What has worked, that money wants out. It wants to go elsewhere. Where does it want to go? We have some clues. You can see the portfolio shifts that we've seen. Small caps, international. Where in international? That's a big part of it. The rest of the globe's a big place. You don't want to just pick all willy-nilly lollygag. You need to be specific with where you're going. Who would have bet that since 2020, Greece. Oh, remember when I mentioned earlier Greece, the debt crisis, the thing that was going to end the Eurozone? Who would have bet that they're up more than 2 times the S&P 500? As I'm using a proxy. This is a Greece ETF. Who would have bet on that? Not many people. Why Greece? Why is it up so high? Think about who Greece is in the world stage, on the world stage. Think about Jacqueline Onassis Kennedy. Onassis. What was he known for? Yeah, shipping. Think about global trade. Think about where Greece is positioned. One of their top industries as a country, financing and the operation of shipping organizations. Well, if globalization is slowing, regionalization is becoming a bigger thing, wouldn't that be bad for shipping? No. It just means that their shipping contracts, they're now in the bargaining position. And it's not just shipping. That I'm just using one example. But it's also, this is a byproduct, this is a subset of watching the easy money policy that the US did post GFC was adopted eventually by the austerity measures that were taken by the Eurozone and many other countries. They abandoned that and they're now pumping, which is why going back to portfolio, getting inflation protected securities in other countries is very beneficial because it's not relying solely on the treasury market. It's not relying solely on the US and the US's dollar. But critical materials, real economy, basic materials, consumer durables, not consumer staples. We're watching the money shifting out of consumer cyclicals, out of utilities, and that's a bit of a tricky one because utilities have been so hot due to the energy needs of AI and all the hype around AI. But those are normally very boring. So they may actually stabilize quickly, but right now we're watching the money move out of the utilities, back into basic materials, back into boring stuff, back into pharmaceuticals, back into healthcare. So that's telling us that we're just seeing rotation. We're not seeing bearishness. But what that's going to mean for you as investors, and especially as you're looking at the broader market, be very aware of the fact that the S&P 500, the main indexes, the NASDAQ 100, they are going to look very ugly respective to the actual health of the rest of the market. Mainly because they have that over-concentrated effect in these positions, these stocks, that have become so large that they won't sell out of them because the index rules would suggest they'd have to come so far back down. But that leaves a lot of room for them to come back down before they get replaced by some other, remember once upon a time, like XLE, or not XLE, excuse me, ExxonMobil was one of the largest positions in the S&P 500, and now it's virtually nothing. Okay. But it took a lot of decline to get it out or to get it down. But that's going to make the headline numbers look a little bit rough. But under the surface, there's a lot of strength still. That's a good thing. But it also means that sentiment around the markets is at risk because so many investors have passive investment in those major indexes. And they're going to start seeing selling. And then they're going to panic, which is what they tend to do. And that panic could carry over to the rest of the market. But here's the biggest caveat to it all, where that may or may not happen. And if we have signals that suggest it is, we're going to also move. But the other part of the puzzle is that the big money, the big institutional money, not just the retail investors, not just the U's and I's, the Main Street of the world, but the bigger market picture as a whole, they're also looking at where do we put money when we want it to be safe? If I get out of these things that are risky, where do we go? Because I don't want to just sit in the dollar, because the dollar is at tremendous risk now, more than ever in our recent, let's say, post Bretton Woods world, post 19, for rounding sake, let's say 1950 world. Well, where are they going to go? Well, they go to bonds, right? Bonds are safe. Well, not if Warsh raises rates, but we don't think he's going to do that. So maybe it is bonds. What do you think about debt as a general concept in today's world? Most people feel like everybody's a bit overextended. They've been spending a little more than they want to, or that they should. They've been borrowing, borrowing. The same is the case for these companies, for stocks, for corporate loans. So then it's okay, is it municipalities? Generally speaking, municipalities have had to rein it in because they're not getting the same federal monies, right? They're not doing these big public works projects, or at least most places aren't. Coincidentally, DC putting in a new stadium at the behest, or rather on the shoulders of the taxpayer. But the question becomes, where do you go? International markets present tremendous opportunity because they are still fairly valued relative to the rest of the US market, which has become quite overvalued. But also, it's not the whole US market that's been overvalued. There's a lot of smaller companies, there's a lot of forgotten companies, a lot of companies that have just been chugging along, but they're not sexy, they're not fun, they're not exciting. Those might be the safe places where the money chases. But beyond all of that, commodities, real physical things that are limited based on either quantity limitations or production limitations. And they're things that are necessary no matter what happens. That's why we have the critical materials in the portfolio. That's why we have some mining in the portfolio, some metals in the portfolio. We're looking to be able to weather storms because as of right now, the signals are suggesting that it's going to be a stormy year, but it will still be a year that has opportunities. We just have to be able to make sure that those opportunities don't present an excess risk to the return that they can afford. And that's where the measured approach to the portfolios comes in. So that was a long drive on what's going on. Takeaways: metal market demand is still there. Paper market has divorced. They need to come back together. When they do, we will probably see some continued appreciation because the demand remains. If the critical industries in America that Trump has promised effectively the people are going to be stabilized, right? The AI infrastructure, the whole Oracle deal, all of this technocracy nonsense that I don't necessarily love, but that's where a lot of federal money is going towards. Okay. If you're getting the promise from the government to stabilize those markets in the event of, trouble, that also tells me that those are being stabilized by critical materials reserves. All right. Energy right now, and this is the one chart I mentioned earlier that I want to bring back up. Pricing oil in today's market doesn't look very interesting. Bear with me as I pull this up. All right, so here's your crude oil futures on light crude. All right, take it way back. Let's put it on a monthly chart so we can go way back in time to 1980s, mid 80s. That's how far back we have data on this. Doesn't look too bad, right? It's not super suppressed. What happened here? Oh, that was COVID. That was that weird time when nobody wanted to take delivery because there were all these oil contracts, but the economy shut down. And people that had these contracts were like, wait a minute, I have to take delivery? I don't want it. It's the opposite of the metals market today. So they were like, I'll pay you to take it. Just somebody else I don't have anywhere to put it. What are you going to do if they just like comes pouring oil on your front porch? Um, that doesn't look that bad. However, let's put it into different context. Let's price it. There we go. Let's price it in the terms of gold, that store of value. Here's an important takeaway. Gold is not up in price. I know. Wait, you just showed us a chart that said it was. No, gold's worth the same amount. It's worth gold. Yeah, there's some perception of it, right? What's the perceived value? But the problem is dollar. The dollar is worth that much less. It's the dollar that is the problem. It is the currency you buy gold in that is the problem. Gold is not up. Gold is a store of value. It doesn't appreciate because it doesn't do anything more. We haven't invented a new use for gold. It hasn't become more valuable other than more people want it because they want the other stuff less, which means the other things are what change in value. It's not gold. Therefore, when you price something in gold, that's giving you a real price. Look at where we are. That COVID low, where I said people are paying you just because they didn't want delivery, that's where we're priced at on crude. In other words, very unique, very, one-off situation that we can point at and say, this is why. And you can watch the hemorrhage down. It was already in a downtrend, sure, but it hemorrhaged down. This has just been slowly creeping right back down there. You think it's going to go a whole lot lower? Maybe it will. But I will tell you that based on the Venezuela affair, based on critical materials, based on the fact that Biden sold the strategic petroleum reserves down and they've been rebuilding, based on all the factors that we've just talked about, oil is going to be a very important resource in the grand puzzle. We're going to participate in that. So that's enough. I hope this was a valuable story for you. I hope that this was not something that's going to leave you with concerns over the weekend. I bring this to light because if you have an understanding of all of the pieces in the puzzle, or at least most of them, you know what picture we're trying to display with the puzzle pieces. When that picture appears in front of you, you understand, oh yeah, there it is. Okay. Hopefully you've positioned for it. In our case, that's the plan. Hopefully you're willing to pivot and change your mind if the story changes. But knowing and having a fair expectation of what is likely to come next without trying to prognosticate on what will come next is such a critical piece in making sure that you not only live a fulfilling financial life, a worry-free, a peace of mind financial life, but it's also those critical pieces are what help you avoid the trap, the emotional traps that are going to be set for you along the way. Because any years, especially these that have extreme volatility, which is again what we're currently expecting, they're going to be trapped. They're going to be traps that are going to be set for you that you're going to be sitting there going, oh, no, 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 no. I need to do this. I need to do that. If instead you have a clear understanding, this is what is likely to happen and it's playing out. Now you're not going to be making those irrational moves. And instead you're going to be taking measured steps for protection, for your own sake, for your own career, for your own, whatever it might be. So I hope you found this helpful. Until next time, I'm Casey Folt. Talk to you soon. Bye-bye.